Hey there everyone, welcome back to my channel. I'm Whitney Michael, your friendly neighborhood realtor, and today we're going to dive into an incredibly important topic for all potential home buyers out there: credit scores. Whether you're a first-time home buyer or looking to move into your dream home, understanding your credit score is crucial. So let's break down what a credit score is, how it's calculated, and what you can do to improve it. First things first, what is a credit score? Simply put, it's a 3-digit number that represents your credit worthiness. It ranges from 300 to 850, with higher scores indicating better credit. A good credit score can make a huge difference in the interest rate you get on your mortgage and other loans. Now, your credit score is determined by 5 main factors. Let's break them down. You have your payment history, which is 35% of your credit score, amounts owed, which is 30% of your credit score, length of credit history, which is 15% of your credit score, your credit mix, which is 10% of your credit score, and new credit, which is 10% of your credit score. Payment history is the most significant factor. Let me say that again. Payment history is the most significant factor. Pay your bills on time. One more time. Pay your bills on time. Lenders want to know if you pay your bills on time. Late payments can really hurt your score, so make sure you're always on top of your payments. This is very crucial. If you cannot make your payment on time, it is imperative that you contact the creditor to set up some type of payment arrangement. Most creditors understand that life happens. Sometimes people can't pay their bills on time. Just call and have a conversation with them. Now, here are 3 tips for maintaining a good payment history. Set up automatic payment for your bills. Sometimes people forget to pay bills in the busyness of life, so just put it on auto pay so that way you don't have to think about it. Use calendar reminders for due dates. Hopefully, in today's day and age, if you have a busy life, you're utilizing some type of calendar or some type of organization system. Putting the due dates on the calendar can help you with this. Now, listen to this. Pay at least the minimum amount due, if not the full balance. I will always recommend paying more than what's due, but at a bare minimum, you have to pay the minimum amount due. Next, we have amounts owed. This refers to how much of your available credit you're using. The trick is you want to aim to keep your credit utilization below 30% to maintain a healthy credit score. Credit utilization is the ratio of your current credit card balances to your total credit limits. It's calculated by dividing your total credit card debt by your total credit limit, and then multiplying by 100 to get a percentage. So of course, we have to take a look at an example. If you have a total credit limit of $10,000 and your total credit card debt is $2,500, your credit utilization would be 25%. Now, this is a good utilization rate because it's below the recommended maximum of 30%. Now, let's look at what happens when your credit utilization goes over 30%. We'll use a straightforward example to illustrate the impact. In this scenario, you have a credit card with a $1,000 limit and a balance of $400. This means your credit utilization is 40%, which is above the recommended maximum of 30%. Exceeding the 30% credit utilization threshold can have a negative impact on your credit score. Lenders may see higher utilization as a sign that you are over-reliant on credit. Let me say that again. Over-reliant on credit, which can make you a riskier borrower. Now, to manage your credit utilization, try to pay off your balances in full each month. You can also request a credit limit increase if you have a good payment history. Lastly, spread out your expenses across multiple cards. The length of your credit history also plays a role. The longer your history, the better. So if you're new to credit, you simply have to be patient and be responsible for all of your accounts. To build a long credit history, you want to keep all of your old accounts open even if you don't use them often. Always avoid opening too many new accounts in a short period. And lastly, consider becoming an authorized user on a family member's credit card. This can help you lengthen your credit history. Next, credit mix. Credit mix refers to the variety of credit accounts you have. A mix of credit cards, mortgages, and loans shows lenders that you can handle different types of credit responsibility. Now, to diversify your credit, you want to use a mix of credit cards, retail accounts, installment loans, and mortgages. Next, you want to only open new credit accounts when necessary. These are all things that are going to impact your credit mix. Lastly, new credit. Opening several new credit accounts in a short period can be a huge red flag to lenders. Try to space out your credit inquiries. When managing new credit, only apply for credit when you need it. Avoid opening multiple accounts in a short time frame. And check if you're pre-approved for credit card offers before applying. Not just credit card offers, but all offers. Check to make sure you're pre-approved before applying. Now let's debunk some common credit score myths. Myth number 1, checking your credit score hurts your credit. Fact, checking your credit score, also known as a soft inquiry, does not affect your credit. Myth number 2, closing old accounts will improve your credit score. Fact, closing old accounts can actually shorten your credit history and reduce your score. Myth number 3, paying off a debt automatically removes it from your credit report. Fact, paid off debts remain on your credit report for up to 7 years, but their impact lessens over time. So how can you improve your credit score? Here are a few tips. Pay your bills on time, keep your credit utilization low, don't close old accounts, limit new credit inquiries, regularly check your credit report for errors. Now, some additional tips include dispute any errors on your credit report, pay off any and all collections accounts, use a secured credit card to build or rebuild your credit. Now, lastly, I want to tackle 2 common credit questions. How often should I check my credit score? Check your credit score at least once a year, but ideally every few months. I personally like to use annualcreditreport.com. Also, most banks nowadays offer your credit score on their mobile banking app as well. Lastly, a lot of people use Credit Karma. Credit Karma is fine. However, you must remember that Credit Karma gives you a Vantage credit score. Most creditors will use a FICO credit score to get you approved for any type of credit. So the Credit Karma Vantage score is not always accurate when it comes to applying for new credit. Next question, can I improve my score if I have a lot of debt? The answer is yes. Start by paying down high interest debts and making consistent payments. I'll preach this until I die. Dave Ramsey's baby step program works. It changed our life. You can go back and watch the video where I'm talking about it. It changed our life completely, and I know it can change yours as well if you follow the steps. Now, remember, a good credit score opens the door to better mortgage rates and can save you thousands of dollars in the long run. If you have any questions or need personalized advice, feel free to reach out to me. I'm here to help you every step of the way on your home buying journey. Thank you so much for watching. Don't forget to like, comment, subscribe, and share for more real estate tips and advice. Until next time, happy house hunting. Peace.